The SEC just went from no way to get ready seemingly overnight. And if you blink, you might just miss XRP and Solana sliding onto Wall Street's main stage. So think the Bitcoin ETF hype was big? Well, that was just the rehearsal. This is opening night. Now, a couple of evenings ago, I was doom scrolling through a half dozen Reddit threads when a single line in a Bloomberg terminal alert made me choke on my cold brew. The SEC issues comprehensive crypto ETP guidelines. Now, my brain did a double take. Wait, guidance? From the kind of same agency that's been tossing subpoenas at half of the industry like confetti? Well, I had to kind of grab my hoodie, I fired up every monitor in the room, and I started digging. Okay, so here's the quick backstory for anyone who's blissfully missed the regulatory soap opera. Up until now, launching a US crypto ETF meant slogging through the kind of arcane from a 19B-4 process. Picture doing your taxes while blindfolded twice, right? It drags approvals out to a soul-crushing 240 days and lets the SEC hit pause whenever they get jitters. Now that process wasn't built for an industry that moves at meme speed. So issuers have been stuck knocking at a door that never fully opened. Then the power shifted. A more crypto-friendly Republican leadership showed up at the SEC, and suddenly the vibe flipped from "you shall not pass" to "let's chat." Now they tossed a bunch of old enforcement actions, formed a task force, and, this is the plot twist, started writing down how to get an ETF greenlit in plain English. Now I'm talking about instructions on custody, volatility, competition, and disclosures, so clear that your grandmother could understand them. Now it's like the teacher finally handed out the answer key that we've been begging for since 2017. Now, remember Matt Hogan over at Bitwise? Well, he's been filing applications like lottery tickets, 6 pending right now. Now his take was priceless, right? He says, "The most fascinating thing about this guidance is that it exists." The translation there is, the very act of publishing it means the SEC is no longer, or at least no longer sees, crypto funds as fringe experiments. Right? They're actually posting the rulebook on the wall, which, only actually happens when you're serious about letting the game proceed. But here is the kicker. The guidance is just Act 1. Act 2 is the universal listing rule that could trash the dreaded 19B-4 entirely. Insiders say that the SEC is hammering it out with NASDAQ and, CBOL, as we kind of speak. Now, if they nail it, approval times could shrink from 240 days to a breezy 75. That's faster than a Starbucks pumpkin spice comeback. So let's think about what that does to market psychology then. Right now, big institutions see crypto as a carnival ride, fun, but someone might throw up. Shorten the line, add safety rails, and suddenly the suits in Midtown start buying tickets. Now we're talking legit spot ETFs for Solana, XRP, Polkadot, Cardano, Dogecoin, and yes, President Trump's meme coin. That still kind of cracks me up every time that I type it in. Meme stock energy with presidential headlines, only in 2025 apparently. Now, this isn't just policy chatter either. REX Financial and Osprey Funds already tested the waters on July 1st with their SOL plus staking ETF. They used an offshore sleeve to hold actual SOL, and a non-US fund tossed in staking rewards for dessert, and boom, $12 million flooded in a single day. Investors practically sprinted to it like it was the last PlayStation on Black Friday. Now that ETF is basically a dress rehearsal for the real Solana spot product, right? They're just kind of waiting on the SEC to say action. Okay, let's pause the experiment here for a second and notice the breadcrumbs. Guidance, a pending universal rule, and workarounds already scoring 8-figure inflows. When dots connect themselves like this, you don't need a conspiracy board with red strings to see the shape of what's coming. Now, we might soon witness the biggest altcoin legitimacy leap since Ethereum convinced banks that smart contracts were not magic beans. But let's be real, there's a nagging question in every holder's mind. Will the SEC actually follow through? Or is this just another, head fake? And that skepticism is justified, right? We've had enough rug pulls to kind of knit a throw blanket the size of Texas. So here's my personal kind of limitless kind of test on this. Watch the language, right? When regulators move from defensive words like concerns and risk to collaborative words like framework and guidance, there's a kind of tectonic shift. Words are their currency at the end of the day, and they just dumped a bag of bullish coins on the table. With that said though, let's not confuse a clearer path with an easy ride, right? The SEC wants plain English risk disclosures, which translates to if your product blows up, you warned them, right? Now ETFs will need airtight custody solutions, ironclad insurance, and probably I should say, a top-tier auditor that's babysitting the actual vault. Now that costs real money and weeds out the half-baked ventures, which honestly is probably a good thing for anyone and everyone except shady operators who thrive on the fog. We've all seen those shitcoins that have just rug pulled everyone, right? We don't want those guys aiming for an ETF. And let's not forget the race condition between the SEC schedule and the market FOMO either, right? Issuers expect the second major guidance drop in Q4 2025. And if that lands right after, Bitcoin's had an all-time high, altcoin ETFs could arrive, and just as retail investors are itching for something new but safe. So picture grandma calling from Florida asking how to stake XRP in her retirement account. Wild, but it's actually entirely plausible. Now, here's where it gets spicy for me personally. I've been tracking the XRP community since the very first time someone screamed $589 at least year end, right? That was back in 2018. Hell, there was stuff happening in 2020 where XRP was going to be pegged against gold, right? I've been tracking it all. Now, those folk, of course, have more patience than monks at this point. An actual regulated XRP ETF would finally put the pipe in the pipe dream, as in pipeline for institutional dollars, that is. Now, the circulating supply just became a potential liquidity sink for mutual funds, pension funds, and robo-advisor portfolios that previously couldn't touch it with a 10-foot compliance pole. So let's zoom out and see a domino effect. ETFs create demand. Demand tightens the supply. Price movements get more respectable, and in theory, that spills back into on-chain activity. More liquidity for payments, bigger pools for lending. Solana could see similar feedback loops too. Layering staking yields on top of that is like frosting. It's kind of like a flywheel that's made of gold ETFs, or that made a gold ETF, I should say, $1 trillion phenomenon, right? Except this time around, the asset doesn't just sit in a vault. It validates blocks, it settles remittances, it spins up NFTs, and fuels entire ecosystems. That's gold with a Wi-Fi signal then. All right, reality check incoming, and this one might just shock you, but I'm not a financial advisor and nothing in this video is financial advice. Cryptocurrencies are highly volatile and you could lose all of the money that you invest. You should always do your own research and consult a qualified professional. After all, your investments are entirely your responsibility, and you should know that nothing is ever guaranteed when it comes to investing. Neither I, this channel, nor YouTube are liable for any losses in today's video. It is for entertainment and educational purposes only. Now, let's get back to the regularly scheduled Geek Out. Now, when news of the kind of forthcoming universal rule leaked, I kind of pinged a buddy who kind of builds ETF baskets for a living. Now, he replied with a single GIF, a roller coaster, I guess, ricocheting upwards. Right? The translation was that get ready for volatility spikes as traders front run the guidance drop. Then the calm as actual products absorb demand. Then we saw that playbook with Bitcoin earlier in 2024. Now price pumps on the rumor, dips on the bureaucratic delays, and then a kind of relentless march north once the first ticker, that BTCA, hit the New York Stock Exchange. History rarely repeats exactly, but it loves a good remix. Now here's something that no one is talking about. The shortened 75-day window could compress marketing cycles. Issuers will need to capture attention faster, which means more mainstream coverage, viral social campaigns, maybe even Super Bowl ads featuring cartoon dogs and lightning bolts. Who knows? The marketing blitz will leak into retail consciousness before the funds even launch, turning your casual interest, at least interested cousin, into a "why don't I own any soul" meme overnight. Another angle is staking yields inside an ETF wrapper, right? Traditional income investors hunt for dividends. Now imagine handing them a regulated product that splits out staking rewards while the underlying asset appreciates. It's kind of like buying an apple tree that also brews cider on the weekend. Right, the demand from yield junkies alone could be enormous, especially in a world where bonds aren't, paying as much as, well, the inflation. But let's be real, risk remains. Custody hacks, validators slashing, and smart contract bugs don't vanish because an ETF exists. They just become someone else's headache. Yeah, if that someone is a trillion-dollar asset manager, trust me, they'll demand institutional grade safeguards. Now, in other words, the ETF race will force infrastructure maturity across wallets, staking providers, and price oracles. The bar just got raised for the entire industry. Personal confession time, right? I've been using Kraken Pro for my own altcoin trades because their interface feels like a cockpit rather than a carnival ride. And yes, the link in the description is an affiliate link that kicks back, at least a little back, to the channel here and keeps the lights on. So if you're hunting for deep liquidity for XRP or Solana ahead of the ETF buzz, well, that's where I've been placing my limit orders instead of crossing my fingers on some sketchy exchange. And speaking of communities, if all this ETF talk makes your head spin faster than Solana TPS, then jump into our free educational Discord server. The link is in the description. We break down the jargon, we share charts, and roast each other's hopium with friendly banter. Now, if you're kind of tired of screaming into the Twitter void, then come and hang out with people who will celebrate your wins and sanity check your moon calls. Now, let's kind of stitch this narrative together with a little timeline forecasting. Right, we're in July of 2025 at the point of recording. Right, guidance document number 1 just landed. Universal rule is the internal draft, with kind of whispers of public release by August. Exchanges kind of file under the new framework within weeks. The SEC clocks start ticking, 75 days, lands us kind of squarely in late October, conveniently near the annual Money 2020 conference where, every kind of fintech exec kind of loops Vegas. Imagine the headlines then, right? SEC approves XRP, Solana ETFs launch, and Vegas will go kind of full crypto neon. So from there, you got to watch a kind of domino filing then, right? Polkadot, Dogecoin, Trump coin, can't even believe that that's a real thing. And maybe even a wild card like Chainlink, which I'm surprised, isn't at the top of the list. Now, each approval incrementally normalizes the idea that major blockchains, deserve a Wall Street doorway. By the second half of 2026, you could be allocating to a diversified basket of staked altcoins through your retirement account's boring old brokerage portal. Grandma's Florida condo might finally have an XRP ticker scrolling on CNBC between weather updates and ads for reverse mortgages. Now, let's zoom into the psychological climax here, right? Price discovery. Bitcoin's ETF debut, it didn't multiply its market cap overnight. It layered a kind of floor under corrections and tightened spreads. Now, altcoins are thinner, more volatile, and potentially more reflective. Now, if even a modest slice of the kind of $40 trillion US mutual fund universe dips a toe into XRP or Solana, well, the supply-demand totter, gets kind of lopsided rather fast. And we're talking about price swings that make 2021's bull run look like a warm-up lap. But before visions of private islands kind of tempt us, we should remember in the sobering side. Regulation can slam on the brakes as quickly as it presses the gas. A high-profile custody breach, chain outage, in Solana's case, or political kind of scandal could spook the same SEC commissioners that we're kind of praising today. That's why diligence, position sizing, and kind of mental stop losses matter. Market cycles are ruthless professors. You learn or you repeat the class. Still, my gut says that we're witnessing the institutional tipping point. The SEC's new script turns what used to be a speculative Wild West into a structured arena. And if history teaches us anything, it's that once institutions have rules to follow, they rush in like teenagers at an end-of-season sale. Early movers get the best racks. Latecomers sift through the leftovers. Your job isn't to camp outside the store, but to know which aisle you want the second the doors swing open. So here's a quick thought experiment then, right? If Solana's staking ETF reaches $1 billion in assets within 6 months, roughly Bitcoin's ETF's early kind of trajectory, annual staking rewards at 6% could shovel $60 million of SOL back to shareholders. That inflow cycles into validator commissions, dev grants, and community growth, reinforcing the network. Similar math for XRP on ledger transaction fees could spark more institutional liquidity corridors, economic flywheels everywhere that you look. Now, I can't predict prices with 100% certainty, but I can map incentives. And right now, the incentives point to regulators wanting orderly markets, issuers wanting first mover advantages, and investors wanting exposure without keyboard war room stress. That triangular alignment doesn't happen very often, and when it does, markets don't just inch forward, they actually lunge. And so, where does that leave us? In a kind of meta kind of scene, we're kind of graduating from will crypto survive regulation to how will regulation accelerate crypto? That's a sea-layer change kind of mindset then, right? It kind of means the next bear market could be less about external kind of fear and more about adopting new tech at discounted prices, like snapping up Amazon stock in 2001 while analysts cried .com collapse, right? The existential kind of risk premium melts when the watchdog hands you a user manual. All said and done, I'm not here to sell dreams. I'm here to kind of share the breadcrumbs, the aha moments, and the occasional meme-worthy facepalm. The SEC's latest playbook is a breadcrumb the size of a baguette. Now, if you kind of choose to follow it, do so with your eyes open, mind sharp, and portfolio balanced. If you choose to ignore it, that's fine too. Just know that the game board is shifting whether you roll the dice or not.